Okay, welcome back. Today we'll cover, the first topic. We'll talk about the financial statements. Suppose, say, if you want to know a company, then where to start your first step? Then you may say, you want to check the company's website, you want to find the history of the company or whatever. But, for most people, if you want to know a company financially, it may be a good stop, to first to check the company's financial statements. And for the common financial statements, there are the balance sheet and the income statements, and also the cash flow statements, and also the last one is the statement of the owner's equity. So for today's topic, I will only cover the first two, the balance sheet and the income statement. So the balance sheet will summarize, the company's assets and liability, or the owner's equity. First, it may sound very complicated to you. I will first just give you a simple example. Suppose you want to buy a house, and the house worth something like $200,000. And so that summarizes the assets value. It is $200,000. Another thing people want to know is how you buy this house. What's the amount you put for the down payment and what's the amount of the loan. So this is the simple, the example for the balance sheet. So here you see the $200,000 of the housing value, that is total assets value. And also the loan amount may be something like $150,000. So that tells you you have the liability, that is $150,000. So in the long run, you have to pay off this $150, over your mortgage loans or whatever. And another part you see, for the balance sheet, it has to be balanced. So the value of the house right now is $200,000, and you have the loan outstanding, that is $150,000. So here you see, you have to have some number to plug in to balance your balance sheet. So here, the $50,000, that is your owner's equity. So that tells you, for this house, you borrowed $150,000 and you have the $50,000, that's your owner's money. So this is one example for the balance sheet. And here, we'll talk about the balance sheet, for a typical balance sheet. The balance sheet, it has the two sides. One side is we talk about the value of the company's assets. So the assets is anything with value, then that will be the company's assets. And the other side is we talk about, how the company finances its assets, whether the money is from the company's shareholders or the company borrowed the money from someone else. So here, we first talk about the assets side. For the assets, we base on their liquidity. Say, how easily they can turn into cash. If they can easily to be converted into cash, then we put them on the top of the assets list. If they are very hard to turn into cash, then we put them at the bottom of the assets list. So here, we have the current assets. The current assets is very liquid assets in the company. And the identification for current assets is saying, the assets will be converted or transformed within a year or one operating cycle. So here, the first items on the current assets is cash or cash equivalent. We know the cash is the most liquid assets. If you want to buy things, you can just use the cash to buy anything you want. So the second item is we call the accounts receivable. Accounts receivable is that the company has sold the products, but they haven't collected the money yet. So it's the company's assets, but the money is will be coming into the company in a while. And another thing is the inventory. So the inventory is the company's assets. They need to sell the products, then the inventory will convert it into accounts receivable. If they get the accounts receivable, then that amount of the value will turn into cash. So that is for the current assets part. And another one is we call the fixed assets. Fixed assets usually is a long-term assets. Then assets will be converted into other formats. Usually it takes a long time. Usually it's more than 1 year. So in this category, we may have the plants, the buildings, and the equipments. They are in this category. That's the fixed assets. And this is the example for the tangible assets. This may also have some kind of intangible assets. Say the company may have the brand name. Brand name has value. The company may have the reputations. They may have some that's the patents there. So this type of the assets we call the intangible assets. They are also the fixed assets belong to the company. And another side we talk about, how the company finance their assets. So there could be, we call the current liability. Current liability saying, that's the company's debt. They need to pay in a short while. So that could be accounts payable. The company received the products from another company, or they received the service. So they receive the bills. They decide to pay, but not paid yet. So that is accounts payable. It's the company's liability. And another one is notes payable. So the company has outstanding loans, so they have the interest payment they need to pay. So the notes payable is also a part of the current liability. Current liability is often, named as the short-term liability. And the company may have the long-term liability. So they have the debt, but this debt they need to pay over a long time, which may be some kind of commercial loans, or maybe for the large corporations, they issue bonds. So the company may need to take several years to pay off these bonds amounts. So that is a long-term liability. And remember, for a balance sheet, it has to be balanced. We know the total assets value, it cannot change because the assets value is determined by the marketplace, right? So by the market demand and the supply. So the assets value is determined by the marketplace. And the accounts payable, that's your debt. You have the contract there. Once you sign the contract, then the number will be less likely to change so dramatically. The only thing can change is owner's equity. So if the company's assets value decrease, then most likely the owner's equity will also decrease. Because for the debt part, you can handle to reduce that amount. For the owner's equity, we have the two parts here. The first part is the common stock. So the company issued the common stocks. The common stock has the values, so the share price may fluctuate all the times. And another part is we call the retained earnings. They belong to shareholders, but they are still inside the company. The company may decide to use the retained earning to pay future dividends, or they may decide to use the retained earning to support the future productions. So that is for the retained earning for the owner's equity part. So this is a typical, that's the balance sheet. Okay, next we'll talk about the income statement. The income statement is summarize the company's sales revenue and the relevant cost. So for the income statement, it's usually first you have the sales revenue, then you deduct all the relevant costs, then the bottom line, that will be the net income you calculate, or you may say the profit of the company. So for a typical income statement, it will start with sales number. And you first record the sales revenue there. And for any direct cost, we call the cost of the goods sold. And the cost of the goods sold usually is associated with the inventories. So if you sell just 1 unit of the products, then the cost of the goods sold will be 1 unit of that inventory. So that's what we call direct cost there. So sales deduct the cost of goods sold, then we have the gross profit. But remember, not is all the salesperson, do job. There's also other people, they're also doing the job in the company, right? Then maybe the HR person, and then maybe that's a marketing person. There are additional expenses for the company. So this part is we call the operating expenses. So that could be the rent for the buildings and the administrative, that's the cost there. All this is part of the operating expenses. So we deduct the operating expenses, and sometimes we also need to deduct the depreciation and amortization. So we will be able to have the operating income. And operating income is also called the earning before interest and taxes. So EBIT. You may have heard these words very often. That is, we call the EBIT. It's the same as the operating income. Remember, for some company, if they have the debt outstanding, so they need to pay the interest payment, right? So the next part of the cost is the interest expenses. So we need to deduct the interest expenses. No one will lend the money to you for free, so you have to pay the money. So that is interest expenses be deducted. And that will be the earning before tax. For the earning before tax, it's usually called the taxable income. So that's the amount you need to pay income tax. So the company need to pay the federal income tax. When we deduct the tax, then we got the net income. So the net income is the company's profit. So here you see, also you have the sales numbers, but for the people in the company, the most interested is net income. That's their profit. So when you set up the company, you want to make money. Then how to measure that part? That is net income. So the net income is the amount of the company's profit. So this is how we calculate the net income from the income statement. And I need to tell you the difference between the balance sheet and the income statement. The balance sheet usually is record the assets value and the liability and the equity as the time. So usually for most company, when they produce the balance sheet, it may tell you at the end of which day. So for the annual income, for the annual balance sheet, it will be something like at the end of the last day of the year. And if they are preparing the quarterly balance sheet, then that will be as the last day of that quarter. And for the income statement, it is a little different. The income statement is summarizing of the company's activities over a period. So usually for the annual income statement, it will tell you that will cover for that whole year. If that one is quarterly income statement, then it will cover the activities over a quarter. So that's the difference between the balance sheet and the income statement. You may ask, where can I get the information of the financial statements? Actually, there are a lot of websites you can get the income statements. One authentic place you should go to is SEC's website. SEC has the EDGAR website. So that's all the public listed company, they are required by law to disclose their financial statements. So the SEC's EDGAR website, they contains all the financial statements, information. You will be able to get there. But for that financial statements, they are quite complicated. For most of the people, you just want to have some brief ideas of the company. So there are several other places you can go to. One place is Yahoo Finance. You can go there to find the company's the financial statements. Or you can go to the Google Finance. You can find the financial statements there. And for the Limestone College, the library has the subscriptions to two very good financial database. One is the S&P Net Advantage. Then you will be able to go there to see the company's financial statements and also a lot of the financial analysis report there. Even you want to do some your personal investments, then that is very good source to get that information. And another database we have is the Merchant Online. It also covers a lot of the company's financial statements. And for the Merchant Online, it also includes the compensation information for the executive, the top executives, the compensations. And that's the part, for the second top, for the first topic for the financial statements.